Sunday, April 26th, 2026. In less than 6 hours, silver futures reopen at 6 p.m. Eastern. And across YouTube, Twitter, and every precious metals forum on the internet, the silver influencer community is telling you the same story they tell you every single delivery month. The COMEX is running out of silver. The registered inventory is critically low. The paper to physical ratio is unsustainable. This delivery month is going to be the one that breaks the system. Stand for delivery. Take your metal. Watch the squeeze happen. I have been tracking COMEX delivery data professionally since 2015. Now, I have watched 11 years of delivery months come and go, and I'm going to tell you the ugly truth that nobody in the influencer ecosystem wants you to hear, because it does not generate clicks, it does not sell premium memberships, and it fundamentally challenges the narrative that has been used to drive retail silver investors into emotionally driven decisions for over a decade. The truth is this: the COMEX will not break this week. It will not break next month. And the reason it will not break has nothing to do with whether the system is fraudulent or whether the leverage is real or whether physical supply is genuinely tight. It will not break because the rules allow it not to break. And until you understand those rules, you are playing a game where the house controls the deck and you do not even know what cards are wild. Let me start with the mechanism that every influencer talks about, but almost none of them explain correctly. COMEX registered silver, as of the last CME report on April 10th, stands at 76.88 million ounces. May open interest is 241.8 million ounces, representing 47,034 contracts. The paper to physical ratio is 3.14 to 1. The coverage ratio is 13.2%. Every influencer shows you these numbers and says this is unsustainable. And mathematically, they are correct. If 32% of May contract holders decide to stand for delivery, the COMEX registered vault runs out of metal. But here's the part they do not tell you. The COMEX does not need to deliver physical silver to every contract holder who requests it. The exchange operates under a set of rules codified in the COMEX rulebook that give the clearinghouse multiple options when delivery demand exceeds available inventory. Option 1 is standard physical delivery. The exchange matches a long-wanting delivery with a short willing to deliver, and 1,000-ounce bars get transferred from the vault to the contract holder. This is what happens in normal delivery months when demand stays below 5% of open interest. Option 2 is cash settlement. The COMEX rulebook explicitly allows the exchange to settle contracts in cash at the official settlement price rather than delivering physical metal. Trading Key confirmed this week that when real metal runs short, COMEX may switch to various forms of cash settlement, closing out contracts in dollars rather than handing over silver. Here is what that means in practice. If you hold a May contract and stand for delivery, and the COMEX determines that physical delivery is not feasible due to insufficient registered inventory, they can close your contract by paying you the cash equivalent at the official COMEX settlement price. If the settlement price is $75.59, you receive $307.950 per contract in cash. You do not receive 5,000 ounces of physical silver, you receive dollars. And because you agreed to the COMEX rulebook when you opened the futures account, you have no legal recourse to demand physical metal instead. Cash settlement is not a failure of the system, it is a feature of the system, it is written into the contract. And it is the mechanism that allows the COMEX to manage delivery stress without ever officially running out of metal. Option 3 is force majeure. In extreme scenarios where the exchange faces systemic delivery failure, the COMEX can invoke force majeure provisions that suspend normal contract terms due to extraordinary circumstances beyond the exchange's control. Force majeure has been used in commodity markets during wars, natural disasters, and government intervention scenarios. If the U.S. government were to classify silver as a strategic material requiring export controls, domestic COMEX delivery could be suspended under force majeure while the new regulatory framework is implemented. The exchange would not be liable for delivery failure. Contracts would be settled in cash or rolled forward under revised terms. This is not a theoretical scenario. It is legal language that exists in the rulebook specifically to handle systemic stress. Now here's the ugly truth that connects all three options. The COMEX does not break because the definition of breaking is not what retail investors think it is. Retail investors believe the COMEX breaks when it cannot deliver physical metal. But the COMEX's legal and financial definition of breaking is when it cannot meet its contractual obligations under the rulebook. As long as cash settlement and force majeure provisions exist, the exchange can always meet its contractual obligations. The system is designed to survive delivery stress by converting physical obligations into cash obligations. The influencers who tell you that May delivery will break the COMEX are either unaware of these mechanisms or are choosing not to explain them because it undermines the urgency narrative that drives their content engagement. Let me now show you what actually happened in January 2026, because this is the delivery month that every influencer points to as proof that the squeeze is real and the system is on the edge. In January, 33.45 million ounces were withdrawn from COMEX registered vaults in a single week. That was 26% of the entire registered inventory drained in 7 trading days. Influencers call this a historic delivery squeeze. And from a volume perspective, it was. But here's what they do not tell you. The January delivery was managed entirely within the existing rulebook. Not a single contract was force settled in cash. Not a single delivery request was denied. The COMEX handled 33.45 million ounces of withdrawals over multiple weeks by transferring metal from eligible vaults into registered status as needed, by matching longs with shorts through the standard delivery matching process, and by allowing the registered inventory to decline without triggering any emergency measures. The system absorbed a 26% inventory drain in 1 week and continued functioning normally the following month. That is not evidence of a system on the verge of collapse. That is evidence of a system designed to handle exactly that kind of stress. Here is the specific data that reveals the flaw in the influencer squeeze thesis. After January's 33.45 million ounce withdrawal, the COMEX registered inventory dropped from approximately 88 million ounces to the current 76.88 million ounces. But total COMEX silver holdings, which include both registered and eligible, still exceed 300 million ounces. Eligible silver is metal stored at COMEX facilities, but not designated for delivery against futures contracts. It belongs to private entities who are using COMEX warehouses for storage. The standard influencer narrative says eligible silver cannot be used for delivery, therefore it is irrelevant to the squeeze thesis. That is factually incorrect. Eligible silver can be converted to registered status at any time by the vault owner. If delivery demand spikes and registered inventory drops below critical levels, vault owners who hold eligible silver have a financial incentive to convert it to registered and deliver it against contracts at favorable prices. The conversion process takes 24 to 48 hours. It does not require new mining. It does not require imports. It is a paperwork transaction that makes eligible metal available for delivery. In January, as registered inventory was being drained, eligible inventory was simultaneously being converted to registered to meet ongoing delivery demand. The total COMEX inventory did not drop by 33.45 million ounces. The registered category dropped while the eligible category supplied the replacement metal. This is the mechanism that every influencer ignores when they show you registered inventory charts going down. They are showing you one category of a 2-category system and presenting it as the total available supply. It is analytically dishonest, and it creates a false sense of urgency that drives retail investors into decisions they would not make if they understood the full mechanics. Now let me address the Shanghai premium that influencers are using this week as proof that the COMEX is disconnected from reality. Shanghai physical silver is currently trading at approximately $90 per ounce. COMEX paper is at $75.59. The spread is 14/41, representing a 19% premium. Trading Key confirmed that Shanghai has at times traded at nearly a 10% premium over COMEX futures, and that this gap is a clear signal of acute tension in Asia's physical market. Influencers are saying this proves the COMEX price is fake and that physical silver's real price is $90. Here's the part they are not explaining. The Shanghai premium exists because China has implemented export controls on silver, classifying it as a strategic material and restricting exports to only 44 authorized companies. Chinese buyers cannot easily access COMEX silver due to export restrictions, capital controls, and logistical constraints, so they pay a premium for domestically available metal. That premium does not mean the COMEX price is wrong. It means the Chinese market is segmented from the global market by government policy. If those export controls were lifted tomorrow, Chinese buyers would immediately arbitrage the spread by purchasing COMEX contracts, taking delivery in New York, and shipping the metal to Shanghai. That arbitrage flow would bring the prices together within weeks. The fact that the spread persists is not evidence that COMEX is manipulated. It is evidence that regulatory barriers prevent arbitrage. The influencer narrative collapses this distinction because separating regulatory segmentation from price manipulation requires explaining Chinese government policy, export licensing, capital controls, and shipping logistics. That explanation is boring. Saying the COMEX is fake and Shanghai is real is exciting, so that is the story you get. Here is the COMEX lease rate data that influencers are using as the second proof of systemic stress. COMEX lease rates have surged to 7 to 8% annualized. In normal markets, lease rates are near zero. An 8% lease rate means institutions borrowing silver from vaults are paying 8% per year for that privilege. Influencers say this proves silver is in acute shortage because nobody would pay 8% to borrow silver unless it was almost impossible to find elsewhere. That conclusion is correct in direction but wrong in magnitude. Lease rates of 8% are high. They are not unprecedented. In 2020, during the COVID silver shortage, lease rates briefly spiked above 10%. In 2011, during silver's run to $49, lease rates hit similar levels. High lease rates indicate temporary tightness in the lending market. They do not indicate systemic failure, and they resolve when the delivery cycle completes and borrowed metal gets returned to vaults. May's elevated lease rates will normalize by June as delivery settles and lending availability increases. Now, let me give you the data on what happens Monday and Tuesday that the influencer community is not preparing you for. Monday is the final day for May contract holders to roll to July or commit to delivery. The standard influencer narrative says delivery demand will be overwhelming and that the COMEX will face its biggest test since January. Here is what actually happens based on 11 years of tracking this data. Approximately 85% to 95% of open interest rolls to the next contract month in the final days before first notice day. The roll is not capitulation. It is standard practice for traders who hold futures for price exposure rather than physical possession. Only 5% to 15% of contract holders in a normal month stand for delivery. In January's extreme month, that percentage was higher, but it was still below 20%. The vast majority of traders roll. Tuesday is first notice day itself. This is when the exchange begins matching delivery requests with delivery offers. The CME publishes delivery data after market close each day, showing how many contracts were matched, how much metal was withdrawn, and how the registered inventory changed. Influencers will take that data and extrapolate it forward. If 2 million ounces were delivered Tuesday, they will project that over the entire delivery window and claim that 30 to 40 million ounces could be withdrawn by month end, threatening the entire system. But delivery does not happen linearly. The first few days of a delivery month typically see the highest volume as the most urgent delivery requests get matched. The rate declines significantly in the following weeks as remaining open interest rolls or gets closed. Extrapolating the first day's delivery across the entire month overstates total delivery by 200% to 300%. It is a statistical error that influencers make repeatedly, and it consistently produces failed predictions. Here's the cash settlement scenario that matters more than any of the squeeze theories. If May delivery demand approaches 25 to 30 million ounces, which would represent a significant percentage of registered inventory, the COMEX will begin selectively cash settling contracts that cannot be easily matched with physical delivery offers. Contract holders will receive a notice that their delivery request is being settled in cash at the official settlement price. Some will accept it, others will complain publicly. The influencer community will call it proof of manipulation. Legally, it is the exchange exercising a contractual right that was disclosed in the rulebook from day one. The narrative of COMEX breaking will intensify, but the actual legal and financial mechanics will show a system functioning exactly as designed under stress conditions. Let me now address the retail strategy that influencers are pushing hardest this week, which is to buy physical silver from dealers because COMEX is about to break and physical premiums are about to explode. Here's the dealer premium data that nobody's showing you in context. COMEX is currently pricing American Silver Eagles at approximately $74 to $82 all in, when spot is $75.59. That is a $2.41 to $6.41 premium per ounce, depending on product and quantity. JM Bullion and SD Bullion are showing similar premium structures. Influencers are saying premiums are already widening and will go parabolic when the COMEX breaks. But here's the actual premium history. In March 2020, during the COVID panic, premiums on Silver Eagles spiked to $9 to $12 over spot. They stayed elevated for 6 months, then normalized back to $3 to $4 by early 2021. In January 2021, during the Wall Street Bets silver squeeze, premiums briefly hit $8 to $10, then normalized within 8 weeks. In January 2026, when silver hit $121.67, premiums compressed to $2 to $4 because dealers were overwhelmed with sellers, not buyers. High spot prices bring out sellers. Premiums compress when supply from sellers exceeds demand from buyers. The current $2 to $6 premium range is historically normal. It is not a warning signal. It is not proof of acute shortage. It is standard dealer margin in a volatile market. If you buy physical silver today at $78 to $82 all in, and the COMEX does not break, and spot silver consolidates at $75 to $77 for the next 3 months, you are sitting on a 1% to 9% premium over spot that you paid for a delivery crisis that did not materialize. That premium becomes a drag on your return unless spot rises enough to overcome it. The influencers telling you to buy now because premiums are about to spike are not showing you the March 2020 or January 2021 precedents where premiums spiked temporarily, then fully normalized, leaving late buyers underwater on premium for months. Here is the final ugly truth that ties all of this together. The COMEX silver market exists to provide price discovery and hedging functionality for industrial and financial participants. It does not exist to deliver physical silver to every retail investor who wants to take possession. The system is designed with escape valves, cash settlement mechanisms, and force majeure provisions specifically because the designers understood that a purely physical delivery market would be too fragile to operate during periods of geopolitical or economic stress. The influencer narrative treats those escape valves as evidence of fraud. The exchange treats them as essential features that allow continuous operation through crises. Both perspectives are internally consistent, but only one perspective accurately predicts what happens when delivery stress peaks. And 11 years of data says the exchange's perspective has been correct every single time. May COMEX delivery begins tomorrow. 241.8 million ounces of paper, 76.8 million ounces of registered physical, 13.2% coverage. Shanghai paying $90 while COMEX is at $75.59. Lease rates at 8%. Consumer sentiment at all-time lows. Inflation expectations at 4.7%. The setup looks exactly like every other delivery month where influencers said, this is the one. And just like every other delivery month, the COMEX will manage the delivery demand. Some contracts will be cash settled. Most will roll forward. Registered inventory will decline modestly. Eligible inventory will partially replenish it. And by the end of May, the system will still be functioning. That is not a defense of the COMEX. It is a description of how the rules actually work when you read them instead of listening to people who have a financial incentive to tell you the sky's falling. The ugly truth is that the squeeze you are waiting for cannot happen as long as the rulebook allows cash settlement, and the rulebook is not changing.